Hello, my fellows. Today, Wall Street is a global symbol of capitalism, wealth, risk, and power. But once it was just that, a street, a muddy, tree-lined path in lower Manhattan. So, how did this narrow Dutch lane become the beating heart of global finance? This is a story of ambition, speculation, and evolution. This is the birth of Wall Street. The name Wall Street isn't metaphorical. It began with an actual wall. In the 1650s, Dutch settlers built a wooden wall at the northern edge of New Amsterdam, present-day Manhattan. The wall was meant to protect against British and Native American attacks, although it likely never saw a battle. The street that ran alongside it came to be known as the Wallstraat. By 1699, the wall was torn down, and the British renamed the city New York. But the name Wall Street remained, and the area began to evolve from a defensive outpost into a commercial hub. In the 1700s, Wall Street wasn't yet about stocks. It was about trade. Merchants sold commodities: tobacco, sugar, molasses, and slaves. A slave market operated near Wall Street until 1762. Auctions were held for everything from land to livestock to financial debts. The American colonies had no centralized banking or stock exchange. Most commerce was localized or handled through European firms. But this would soon change. The American Revolution created not only a new nation, but a new economic reality. The U.S. government issued war bonds to finance the fight against Britain. After independence, the young nation was deep in debt and in need of a stable financial system. Enter Alexander Hamilton, the first Secretary of the Treasury. He believed in a strong national economy, led by banks and capital markets. He helped establish the first bank of the United States. He advocated for the assumption of state debts, consolidating financial power in federal hands. He laid the groundwork for an American credit system. Hamilton's policies gave birth to an American financial elite, many of whom began gathering in lower Manhattan. The year was 1792. A group of 24 merchants and brokers met under a buttonwood tree on Wall Street. There, they signed a simple document, the Buttonwood Agreement. The agreement's key points: trade only with each other, set fixed commissions on security sales. This was the birth of the New York Stock Exchange, though it wouldn't take that name for decades. What were they trading? Not yet corporate stock. Those were rare. Instead, early Wall Street dealt primarily in government bonds, bank shares, and insurance companies. Companies like the Bank of New York, U.S. Bank, and marine insurance firms were early staples. Speculation quickly followed. Booms and busts emerged, including the Panic of 1792, just months after the Buttonwood Agreement. Even in its infancy, Wall Street was a place of risk, reward, and recklessness. By the mid-1800s, America was industrializing, and as industry grew, so did the need for capital, and Wall Street delivered. Railroads became the first truly national corporations and major securities. The telegraph and ticker tape machines revolutionized trading speed. The NYSE moved indoors, gaining a permanent home at 11 Wall Street in 1867. Corporate titans used Wall Street to fuel their empires and manipulate markets. Insider trading, speculation, and boom-bust cycles became hallmarks of the street. But Wall Street's rise was far from smooth. In the late 1800s, financial panics rocked the economy. Panic of 1873, caused by railroad overexpansion and speculative banking. Panic of 1893, led to bank failures and nationwide depression. Public trust eroded. Calls for reform grew louder. Still, Wall Street survived and evolved. By the early 1900s, New York had eclipsed London as the world's financial capital. The Federal Reserve was created in 1913 to stabilize monetary policy. J.P. Morgan bailed out the government in the Panic of 1907, proving that Wall Street, not Washington, held the real financial power. Wall Street entered its golden age, but the seeds of disaster were already sown. October 29, 1929, Black Tuesday. The stock market crashed. Billions of dollars vanished. The Great Depression had begun. Overspeculation, margin buying, and lack of regulation were major causes. Millions lost savings and jobs. Wall Street's unchecked power had finally caught up with it. Reform was inevitable. In the 1930s, President Franklin D. Roosevelt introduced sweeping reforms. The Securities and Exchange Commission, SEC, was created in 1934. The Glass-Steagall Act separated commercial and investment banking. Transparency, disclosure, and regulation became law. Wall Street was put on a leash, at least for a time. From a wooden wall to a digital empire, Wall Street's journey reflects the evolution of capitalism itself. In 2008, the world saw another crash, triggered by excessive risk-taking on Wall Street. Today, high-frequency trading, crypto, and global finance operate at lightning speed. But the same questions remain. Who controls Wall Street? And who pays the price when it crashes? To understand Wall Street today, we must remember its past, because the next chapter is still being written.